Good morning. Now let's set the context for the six capitals. As we've discussed before, the importance of the subject lies, frankly, in the vast wealth of publicly traded global companies. As we mentioned before, in the year 2000, it was estimated that 51 of the largest 100 economies in the world were not countries but multinational corporations. In 2013, just 2,000 of the largest publicly listed companies employed 87 million people and generated about half the world's GDP. Companies affect countries, communities, shareholders, investors, vendors, suppliers, employees, and impact the environment from sourcing to biodiversity and more. We've also mentioned that there's been a sea change in the way corporate entities are valued in the marketplace today. And if you take a look at Mervin's slide 9, components of market value, intangible assets many years ago were about 17% of the components of the Standard & Poor's market value of an enterprise, and this was in 1975. Today, however, over 81% of the value of a company lies in its intangibles, assets that were not traditionally measured in the financials and not likely seen on their balance sheets. If you take a look at Mervyn King's slide 10, some of the intangible assets that he talks about are really corporate strategy, which you'll be involved in, reputation of the company, supply chain issues and sourcing, human rights, whether they're owned or outsourced, stakeholder relationships, positive and negative impacts, the quality of governance, the quality of management, the quality of corporate responsibility, and frankly, how the company makes money. But the importance of your role is magnified by the fact that, in many people's estimation, it is a fact that some 90 million Americans own shares on U.S. listed companies through their mutual funds. But as mutual fund owners, you have very little contact, very little connection, or very little relationship with the company that you own. 90 million Americans own shares of U.S. listed companies through mutual funds, 401ks, pensions, or retirement plans. And from Mervin's perspective, the fact alone explodes the myth that corporate governance lacks relevance. Strong corporate governance, that is what you will be doing as corporate fiduciaries, provides a bridge of trust between Wall Street and Main Street. High levels of trust and confidence in U.S. companies depend on the widespread adoption of corporate governance principles that command the broadest support within business, capital markets, and critically as a society as a whole. And that's why what's tremendously interesting is that Mervyn goes one step further, and he says the inclusive shareholder model should be supported by practical changes inside the business. And this is something that you may see in your lifetime. The board, this is the board of directors, should appoint a dedicated stakeholder relationship officer, an STRO, an innovation being adopted by many companies outside of this country, to provide insight and information to every board meeting to inform strategic and operational decision making.